What's up, everybody? Ian Shepherdson, the economist who predicted the 2008 housing crash, believes that home prices will fall another 15% in 2023. Shepherdson, the founder and chief U.S. economist for Pantheon Macroeconomics, predicted the eventual housing crash of 2008 back in 2005. He recently suggested that the price-income gap, coupled with increased house supply and high mortgage rates, may precipitate a period of continued deceleration of the housing market rather than a significant rebound this year. On the other hand, Goldman Sachs believes that the U.S. housing market may be nearing its bottom. So who's right and who's wrong? Today we're going to take a look at both positions, and we'll go through two different articles, one from Fortune and one from Fox Business News, and see what they're saying. So let's just dive right in. One thing that we can all agree on is that we have a serious affordability problem that has not been resolved with higher interest rates. And although inventory has grown, it's still less than pre-pandemic levels in most areas, which has kept prices from substantially going down, making homes unaffordable for a lot of people, especially first-time home buyers. So why did Goldman Sachs change their predictions of U.S. home prices falling 6.1% in 2023 on January 10th to their most recent prediction of U.S. home prices falling just 2.6% by the end of 2023? And why does the economist Ian Shepherdson believe that U.S. home prices will fall another 15% or so in 2023? In Lance Lambert's article, Goldman Sachs makes a bold housing market call. He writes that by the time U.S. home prices bottom out this summer, Goldman Sachs says, national home prices will be down 6% from their June 2022 peak. Previously, Goldman Sachs researchers expected that peak to trough decline to come in closer to 10%. We expect a peak to trough decline in national home prices of roughly 6% and for prices to stop declining around mid-year. On a regional basis, we project larger declines along the Pacific Coast and Southwest regions, which have seen the largest increases in inventory on average, and more modest declines across the Mid-Atlantic and Midwest, which have maintained greater affordability over the past couple years, wrote the researchers. So let's take a look at how regional home prices are expected to shift in 2023 and 2024 according to Goldman Sachs. The red bars are the 2023 forecast and the green bars are the 2024 forecast. In 2023, Goldman Sachs expects double-digit home price declines only in the overheated markets, such as Austin down 16%, San Francisco down 14%, San Diego down 13%, Phoenix down 13%, Denver down 11%, Seattle down 11%, Tampa down 11%, and Las Vegas down 11%. On the positive side, Goldman Sachs expects prices to rise in markets like Baltimore up 0.5% and Miami up 0.8%. In 2024, they expect home prices to be down slightly in Austin, down 3.6%, San Francisco down 1.2%, San Diego down 1.4%, Phoenix down 3.6%, Denver down 2.3%, Seattle down 0.3%, and then up in Las Vegas 1.3%, Boston up 2%, Washington D.C. up 2.6%, and the highest prediction on the chart is Baltimore up 4.5%. Unlike Sheperdson, who wrote in a client statement in October of 2022 that he saw no floor in sight for declines in house sales, but was optimistic that continued price drops would eventually help balance out the market sometime in 2023. Goldman Sachs believes there are three reasons why a steeper correction won't happen this cycle. First, the rapid buildup of untapped home equity over the last couple years means that even if prices declined more sharply than we expect, only a small share of mortgage borrowers would be underwater, wrote Goldman Sachs researchers. Second, over 90% of outstanding mortgages are fixed rate, meaning that the rise in interest rates will not lead to a spike in debt service costs for most homeowners. And third, household balance sheets remain strong, with low aggregate leverage and considerable remaining pent-up savings from the COVID-19 pandemic. Those three factors, Goldman Sachs says, should prevent the potential for a large influx of loan defaults, which contributed to the last crash. Sheperdson said in a recent note to clients, "We estimate that single-family home prices have fallen around 5.4% from their peak in May of 2022. But they still need to fall by a further 15% or so before they return to their long-run average compared to disposable incomes." He is not wrong about our current affordability crisis. In most places after the pandemic boom, the local incomes no longer supported the inflated house prices. This is a real problem. But will it cause a housing crash like 2008? Back then, U.S. home prices fell 26% between 2007 and 2012, which is 4 times greater than the 6% peak to trough that Goldman Sachs is predicting this time around. Another aspect of Shepherdson's argument is the supply side of the equation. He believes that home supply will increase moving forward, and prices tend to fall when supply increases. I think that we need to watch the builders and investors to see what they're doing. If the builders and investors, which include all that iBuyer inventory, increase home supply dramatically and also cut prices, we will see a much more drastic price drop. In addition, if inflation gets worse and the Fed continues to step in and raises rates again, this could also cause a further correction. But for now, the median existing sales price was still up 2.6% to $366,900 in December, according to the National Association of Realtors. Though this is the 130th consecutive month of year-over-year price increases, a record streak, the year-over-year increase was at a much slower pace than it was in November. In a January 23rd analyst note to clients, Sheperdson and Pantheon's senior U.S. economist, Caryn wrote that market uncertainty should continue this year as home prices, while declining every month, remain at an unaffordable level. Mortgage rates have fallen by 93 basis points since late October, and demand looks to be rebounding modestly after collapsing last year, read Sheperdson and Clancy's Pantheon note. To be clear, any rebound in sales from here will be small. Monthly payments for a new buyer of an existing home have fallen, but we're still up 54% year over year in December. On the mortgage rate front, Goldman Sachs says buyers shouldn't expect much relief. By the end of 2023, the investment bank predicts it to be around 6.5%. As of last week, the average 30-year fixed rate was 6.09%. So what's the bottom line? Prices are down, but they are still higher than pre-pandemic levels. How much higher just depends on where you live. Interest rates are double what they were during the pandemic boom, but have come down slightly in the past couple weeks. Buyer demand and interest is up, but inventory is still incredibly low. There are just so many mixed messages out there, which is why I always come back to how important it is to watch the builders and investors. I just think that they're the ones that are going to be guiding the market, and that can vary greatly depending on where you live. Sheperdson said prices have to fall substantially in order to restore equilibrium. Supply curve for housing is not flat, so the plunge in demand will drive prices down. This is all very true. If buyers stop buying for whatever reason, prices will have to come down to incentivize them to get back into the market. He goes on to say, we expect a drop of 15 to 20% over the next year in order to restore the pre-COVID price-to-income ratio. I agree with him. It would definitely restore affordability. I'm just not sure it's going to happen, at least where I am in the DC area. So what do you guys think? Which camp are you in? Goldman Sachs or Ian Shepherdson? Definitely comment below, and please tell us where you live so we can see it through your perspective. perspective. We all know that real estate is very localized and we can see the discrepancies all across our country. But the one thing that we all have in common is that housing prices went crazy over the last couple years and became completely unsustainable. How much they need to come down and how much they actually will come down, well, I think the next couple months is really going to tell us a lot. I do hope you got some value out of today's video. I just try to bring you the most up-to-date information so you can make the best decisions for you and your family. And I understand there is a lot of different opinions out there. So let's start the conversation. Tell us where you live, tell us what you're seeing and what you're experiencing, and tell us what you think is going to happen and who you kind of believe, one or the other. And if you did get some value to today's video and you want to show our channel some support, definitely smash that like button and consider subscribing to our channel. It just motivates us to make more videos. Thanks for watching. I do appreciate it. Bye!